Alright, what's good everyone? Today I'm coming on here. I'm gonna try to make this short and sweet, but I'm gonna show you how I trade. And I do trade IFVGs, and this is probably gonna be the easiest way to trade IFVGs without making it complicated. And because I know even when I was starting to trade them, sometimes you get a little confused on how to find biases and you know how to go into every day having your strict plan and without getting all caught up and confused with what's going on in the market. The way I trade is, like I said, super simple. It's the same thing every day. A 5-year-old can trade it. Um, yeah, anyways, let's get into it. So, anyways, here we are, and the major part of basically any ICT strategy or um, anything that trades the way that we do is going to be liquidity. Liquidity is superior than your entry model, than, let's say, I don't know, you finding your bias. Because the way I trade, which makes things a lot easier mentally and less stressful, is liquidity. So when I come into every day, obviously expecting that you check the news and seeing if news is coming out at a certain time, because that's the most volatile spot, besides New York Open at 9:30. You check your news. You know when news is dropping because you don't want to place a trade in that and get wrecked. This is going to be where you're going to start. All right. So let's get a text. I'm going to go step 1. Liquidity. Oh, that's not it. That's not the one. Alright, so step 1 is going to be your liquidity. Now, when I come out on the charts, I'm marking out my London highs and lows, which, if you see here, there's London high, which is this red line right here. And then so you're going to have your London highs, your London lows. You're going to mark them out with the horizontal ray. And then you're going to mark out your 4 hours highs and lows, and then previous day highs and lows. Now, to make it super simple, that's what you're going to start out with. Now, since we have London high right here, now what time is this? We're on a 15-minute time frame. We're at 9:15. So, easiest way to make this simple on your brain, so you're not giving yourself fucking, a headache. You want to react. You're not predicting. Predicting, it's if it doesn't go on your way, you're gonna end up getting crushed, and then it's gonna fuck with you mentally. So this is gonna save you in that sense. So you mark out your liquidity zones, and right here, if you see the horizontal line, we have 9:30 a.m. open. All right. Now, obviously, before dropping down to the 15, after you have all your levels marked out, this is gonna be very useful. So obviously, after you marked out your 4 hours highs and lows, you're going to see if these highs or lows are in fair value gaps, because if there's a high and low that's in those higher time frame for gaps, they're going to be a higher probability of catching reversal, because that's what we trade, is reversals, sometimes continuations, but that's for another video. We'll go here, liquidity on high low, 1 hour high low, 4 hour high low, previous day high low. And let's just start with that, because it's gonna make it simple, because a lot of reversals end up happening off of this anyways. So obviously there's more liquidity pools, but like I said, I can save those for another video. So now you got your liquidity marked out. Number 2, wait till after open. Now sometimes you will get these sweeps before 9:30 open, but out of my experience, I don't like taking trades in pre-market because there's less volume in the market and less probability of them hitting, and especially if you're going for a bigger win, not saying that you should every day, pre-market isn't going to be it. So anyways, wait for market open, 9:30 a.m. EST. Now we go number 3. Let me see if I can make this a little bigger for you guys. So number 3, wait for open. Oh, sorry, sorry, that was number 2. So after you wait for open, now you're going to wait for one of these major liquidity pools to be swept. Now again, you know, trading's a lot of waiting, a lot of patience. So that's what you're going to be doing. Wait for major liquidity. Oh, sorry. Liquidity pools to be swept. Now, number 4, once liquidity pool is swept, wait for good reaction off lick levels. So now, all right, we're on the 15-minute time frame. You know, assuming that you have your levels marked out, you wait for open. So now, and obviously being aware that, say, if any of these highs or lows are in higher time frame gaps, you want to mark those out too. So like I said, this is going to be in the way. Now we got a gap here that never got closed above, and that was for a gap. Now we go back to the time frame. So that's just an example. So you got your higher time frame gap. You got a high that never closed above. Now the good part about having this type of strategy, it's good to obviously look on the higher time frame to see, yeah, if we're more bullish and we're breaking highs and lows and we're respecting fair value gaps, order blocks, and whatnot, to get like a feel of where market will go, but without predicting. So now, for instance, okay, we're on the 15-minute time frame. Let's move this over just a little bit, and let's move this a little smaller because you don't need to see my face. Alright, so buy side, you have London high low, and then you have a 4-hour high that never got closed above a 4-hour gap, and on the bottom we got a 1-hour sell side level. So now you got buy side and sell side. Now there's more levels obviously if you keep on going deeper or higher in the charts, but let's just say for hindsight, this is what you have. You have a buy side, a sell side. Whatever one gets swept and reacts to the level respectively, that's where you're going to look for your entry. Alright, so 1, marking out your highs and lows. London high, London low, 1 hour, 1 hour high and low, 4-hour high and low, previous day high and low. Alright, number 2, wait for market open at 9:30 a.m. EST. Why? Because probabilities are less likely to end up hitting in the pre-market unless you have super high conviction. 3, wait for a major liquidity pool to be swept. 4, once liquidity pool is swept, wait for a good reaction out of the liquidity levels. Alright, so markets, this is market open on this horizontal line. And now we scale down to, let's just scale down to a 1 minute, because those are where we use our entry models, is the 1 minute, 2 minute, and the 3 minute. I don't really trade or take entries off of take entries off of the 5 minute. Alright, so anyways, we're on the 1 minute. Market's about to open. Mind you, this isn't replay, so this isn't hindsight. So now we're going to play price. Market opens. Boom, level got swept. Now we're waiting for a fair value gap to be inverse down to the opposite way. Very simple. Now in this situation, you can see price shot past the liquidity level, which is still okay as long as it's not ripping to the upside. And then at that point, it's, you know, shorts are not even valid. So typically you'd want to see, there we go. So in the ideal world, you want to see, alright, in the ideal world, this is what you want to see. Price coming up, and say it sweeps just past that and respects it. So then we start targeting and reversing. Okay, so that's in an ideal world. So you want to see price come up, sweep, respect that level, super good, you know, without closing above, and then start retracing and taking out these other low levels that we previously made. So let's take this out of here. Take this out of here. Alright. So now anyways, price has swept after open. Swept the level. It was the 4-hour high and sweeping out London high. So now we scale down to the 3 minute, the 2 minute, or the 1 minute. So now let's play price. So now price closed below the gap. Let's make this bigger so you can see. Now let's go back to our checklist. Now we're gonna add something. 5. So now once the liquidity pool is swept and we wait for a good reaction to the levels, we find an obvious IFVG to be invalidated and inversed with good momentum. So ideally, since we had a death candle right here, we're typically wanting it to close just under the gap so we get a proper entry, but in this case that didn't happen. Price closed way below, but the good thing is we didn't hit this other low, so it's still valid. But that's, like I said, that's another thing. I'm trying to make this easier for you. But price retraced basically near the gap. So what do? We take an entry. Take an entry. and you can even go right to this low because, or wait for a sec. So now price retraced to give us the ideal entry. We entered, stops above the gap, give yourself a little room, maybe about a couple points, and target the next obvious low hanging fruit. So now if we start playing it, play price, boom. Now before I start to explain more, let's just go back to the checklist. Sorry, the last point. Wait for an obvious fair value gap to be invalidated and inverse with good momentum. What do we have? We had good momentum closing below this gap, but it did not take out the next recent low. Now, so if we go here, hold on, let's add in brackets without taking out next recent low, otherwise trade invalid. Hold on a sec, guys. This is such a piss off. Trade invalid. Put it in the bracket. Number 6. Enter with stop loss above the IFVG targeting newer lows or vice versa. Oh, hold on a sec. Older or vice versa. Older highs, depending if you're going long or short. Alright, so let's do a little recap. So one, you get on the charts, obviously expecting you to look for news, like I said. Now number one, what is it? It's liquidity. That's your main thing because you're going to react to price and not predict. Liquidity, London highs and lows, 1 hour highs and lows, 4 hours highs and lows, and previous day highs and lows. Alright? Number two, wait for market open at 9:30 EST. Why? Because probability is less likely to hit in pre-market unless you have super high conviction. Number three, wait for major liquidity pools to be swept. 4, once liquidity pool is swept wait for good reaction off of the liquidity levels. Number 5, we find an obvious fair value gap to be invalidated and inverse with good momentum without taking out the next recent high or low, otherwise the trade is invalid. Number 6, enter with stop loss above the IFVG targeting older highs, older lows, or vice versa, older highs. Like I said, depending if you're going long or short. Now, so if you're still here watching this video, I do have some secret sauce. We'll get to that in a minute. But one thing I wanted to mention too, so when you're looking for, oh, that's not what I wanted. When you're looking for IFVGs to trade, now you got to make sure that, so IFVG checklist, is the gap singular? Is it big enough to have protection / resistance for stop loss? What else? Yeah, so I guess that's all you really got to worry about. Anyways, so make this a little bigger for you. So is it singular? Meaning, aka we have one singular gap, and that's what you're looking to get in first. Is it big enough? Now, let's just make an extra point. IFVG no less than 10-point size. Depending, this will change depending on how market's moving and how volatile. Obviously, the more volatile it is, the bigger you want your IFVG, because it creates protection of your stop loss, because there's more resistance for price to rip right through it, and then you get cooked. IFVGs valid to be bigger. To be bigger. So now, since the market has been volatile with Trump and the war and whatnot, it's usually better to have gaps that are like 20 points, 20 points to 30 points, and assuming that you size accordingly, because the bigger the gap, the more you're going to be risking. So like I said, that's another thing for another video. So anyways, let's go over this. So one, the gap is singular. I mean, there's one gap that's being inversed, either on the 3-minute, the 2-minute, or the 1-minute. Is it big enough to have protection, resistance for stop loss? So obviously, depending on the size of, or just depending on the volatility of the market, the bigger the gap, the more protection you have. And no less than 10-point size gaps. Otherwise, you're just looking to get cooked, unless you want to put your stop above the high or the low instead of just having it above or below the gap. That'll work as well. And yeah, so a little extra sauce for liquidity wise is another way that I take trades off of, instead of just all the liquidity pools that I've mentioned above. And number one is the 50% level of the daily range. So if you see right here, this is the 50% of the daily range, and this will be adjusted depending on how market is moving. But for instance, yeah, so you can basically use it as a resistance level, because it's super strong at respecting levels. You can even see here in pre-market, price came down, respected the 50% level, and maybe might be something better on the 2-minute or 2-minute. Yeah. Now, mind you, this is a smaller gap, so it doesn't. This is basically an invalid trade. But with London high above, we price bounced off of the 50% level. In hindsight, you could have took this, but it's not valid in the way I trade. So you could have been like, stops up on the, under the body, target London high, but that's not a trade I would have took. So if you want to add that as a confluence, you can do that. But this is the easiest way to do it off of liquidity pools, and wait for reactions and reversals out of those liquidity pools. Now, if you want ways to mark out your levels without having to do it manually, we can go over what I use as indicators, because these are the only indicators I use. I don't use indicators for entry models or to get me in certain trades. This is all I use. I use equal highs and lows, because those are another high forms and higher probability of liquidity pools. ICT and pivots. This is the kill zones, ICT kill zones and pivots. So that shows me London high, London lows, all that. The midpoint of daily range, that will give me the daily or the 50% daily range every session, so you don't have to mark that out. There's the previous day high and lows, which will mark out, and the buy side and sell side pivots for the 1 hour and the 4 hour. I do not base my entries off of 15-minute highs and lows, just 1 hour, 4 hours, London highs and lows, previous day highs and lows, and then trades off of the 50% level of the daily range. Alright, I hope this wasn't too confusing. I'm hoping I was able to explain myself as good as possible. So yeah, I hope this helps. This is one of the easiest ways to trade. It has a 70 to 80% win rate, and I highly suggest it if you're struggling. But yeah, I hope you guys have a good day. That was it. Alright, peace. One last thing I wanted to mention, guys. Obviously, this is the beginning of my channel, because I've been so focused on trading itself. I decided that obviously what has helped me and my experience, I'm able to help you guys, and hopefully make that learning curve a lot shorter, and you can learn from the mistakes that I've learned without having to go through those if you're disciplined and will listen. But yeah, if you guys want to see more of this and come along with the journey with me, you can like and subscribe. That'd be awesome. And if you are interested in communicating with me and other traders, there's a link in my bio, and you could join the Discord. It's completely free, but obviously if you do want extra sauce, there will be a small fee, but I'm not even telling you to do that. I don't need you to go do that. I would just like you to join the free Discord, and yeah, let's communicate, let's grow. If you have any questions, you can ask me on there. I'll message you guys back right away, and I can get you guys on the right track. Alright, that's it. Peace.